stock split, reverse stock split, what does that mean? Okay, so if you happen to own individual stocks in your portfolio, okay, and one of the companies happen to do either a stock split or a reverse split, what does that mean? Okay, how does that affect your portfolio? Okay, so it doesn't affect your portfolio in any way. Okay, you don't make any more money, you don't lose anything less. Okay, the net effect is zero, and I'm going to show you why. Let's say you own 1,000 shares of a company and it's trading at $2 right now. Okay, so the value of that position, you own $2,000 worth of that company. Now, if that company decides to, for example, split their stock 2-to-1, what happens is they're multiplying the number of shares they have, including what you have in your portfolio, by 2, and then dividing their share price by 2. Okay, so what ends up happening is you're going to have 2,000 shares of that company, but at $1. Okay, 2 divided by 2 gets 1. 1,000 times 2 is 2,000. Okay, you end up with the same value. Okay, so net, nothing happens. Okay, no change in the value of the company, no change in the value of your position. Same thing with a reverse split. Okay, same example, $2 at 1,000 shares. You have $2,000 worth of this company. If they do a reverse 10-to-1 split, okay, what they're doing is they're dividing the number of shares that they have, including yours, by 10. So 1,000 divided by 10 gets you 100 shares. You're going to own 100 shares of this company. But now they are worth 10 times more. Okay, 10 times 2 gets you $20. You still own $2,000 worth of this company. Again, no change. Nothing happens to your portfolio. So why would companies do reverse splits or stock splits if it does absolutely nothing for their investors? Okay, so let's start with reverse splits. A company would do a reverse split because they have to maintain a certain share value to continue being listed on certain stock exchanges. Okay, so for example, Aurora Cannabis, they recently did a reverse 12-to-1 split because of what was going on, their stock price tanked to, at one point, around 90 cents. Okay, so it was less than $1. They're listed on the New York Stock Exchange and Toronto Stock Exchange. And these exchanges were like, what are you doing? Okay, you cannot be listed on our exchanges. Okay, you are like a peasant right now. Okay, so peasant meaning they're at like penny stock status. Okay, those are not allowed to be listed on those exchanges. So they're like, get your shit together. Okay, do a reverse split. And then you can maintain your listing. Being listed on these stock exchanges also attract investors. Okay, so there are fund managers, portfolio managers. They manage money on behalf of investors, and they may have mandates stating we cannot be investing in penny stocks or companies that are trading below, let's just say $2, because this is deemed too risky for our investors. Okay, so that's why companies would want to maintain their listings with these exchanges, because it maintains certain types of investors. Also, analysts, Wall Street analysts, Bay Street analysts, they also may not be able to cover companies that are trading below, a certain level, or their status is like penny stock. Okay, so these are the reasons why a company would want to prop up the value of their shares by doing a reverse split. But why would a company do a stock split then? Well, let's just say a company has done tremendously well. Let's just say the share price went up to like, I don't know, $5,000 a share. Well, that ends up being out of reach for a lot of other investors, like everyday investors such as you and I. Right? So if they're like, okay, let's just split our stocks so then it becomes more available for more people. So because otherwise these companies that are trading at such high values, like $5,000 a share or $10,000 a share, that's generally reserved for institutional investors. Okay, so funds that have that kind of capital to invest in them. So if a company does a stock split, it's available for more people.